So Mo, can you tell us how your Valmos methodology underpins and informs your holistic investment strategy?
Yeah, I mean, VAMOS is an acronym that stands for, the VA is for valuation, the MO is for momentum, and the S is for sentiment.
I see, yeah.
And so these are sort of the three key pillars, if you like, of our investment decision making. The valuation piece is just a recognition that the biggest risk that any investor runs is the risk of losing money, and you experience that at its highest when stocks are overvalued or any asset is overvalued. Whereas when they're cheap, there's an opportunity to make good returns. So the valuation piece is just a recognition of the importance of valuation. Momentum is essentially trend following. The trend is your friend, and if something is increasing in value, it typically tends to build on itself. Equally, when it's falling in value, that tends to accelerate on the way down, and that is a cause for concern. And sentiment, finally, in the VAMOS framework is going against the herd. If there's a prevailing mood of negativity, that's usually a time to pay attention and perhaps build a position, or if there's a prevailing mood of optimism, that's the time to take caution and reduce your exposure.
So how frequent or how rigidly do you and your team actually follow this, or do you just think about it vaguely?
Yeah, no, we strongly believe in those foundations. So we use data to essentially measure where we are in different asset classes around valuation, momentum, and sentiment. And we look at that dashboard of data, if you like, to make an informed decision. Typically, if all of them are pointing in the same direction, that's a good sign to either add a position or reduce one. But more often than not, you get mixed signals. So you have to overlay that analysis and think how you can further enhance it and add some qualitative analysis over it.
So it's a kind of screening thing, but not the be-all and the end-all.
Yeah, I think it's a strong foundation for investment decision making, and more often than not, we would follow it. In some instances, because we recognize it has shortcomings, like everything, we at times may decide not to follow it because we're not 100% convinced of the signal.
And I mean, we talked about AI today, and do you think that AI can help with investment strategy or with this investment strategy at all?
Yeah, well, without a doubt, actually, technology can further enhance the way that we make investment decisions. It can help us ascertain what information is relevant and equally what information is irrelevant. And the way that AI or any kind of machine learning can strengthen that decision making is by analyzing those inputs to see if they're actually useful to deriving some kind of a conclusion. And so AI is definitely a big help in that respect.
And do you have any particular AI tools at the moment that you have, or are they more in the future?
No. So one of the tools that we currently use is looking at, for example, news flow, and to look at whether the news flow around an investment is negative or positive based on natural language, if you like. Yeah. And then using that news flow to say, well, does that help us make informed decisions about the future returns for that asset class or that asset or that sector? And so we use it in that respect to say where it is helpful, we use it as an input within our VAMOS framework. And if it's not helpful, then we say, actually, it's an irrelevant data point, let's just ignore it.
So it's already there?
It's already in use in some of the investments that we make, yes.
That's interesting. Something else, I mean, we're obviously late in the cycle, and I'm not saying that you think there's a recession, but how do you think that people could prepare for a recession?
Yeah, I think that always the challenge with markets is obviously saying what's relevant in terms of determining the returns of the asset class. And the reality with economic data is some of it, so let's call it the GDP data, is not a very useful predictor of what happens to stock market returns. So even if we head into recession, it doesn't mean to say that financial returns will be bad. So we care less about that. We care much more about data that is, in our opinion, or the analysis that we've shown is relevant. Forward and leading indicators like the ISM data, like the industrial production data, consumer confidence data, leading indicators like those are quite helpful. And at present, they continue to point to a period of perhaps an expansion, maybe a slight slowdown, but nothing that's to the detriment of asset class returns. So from what we observe right now, we still feel there's potential for strong returns from risk assets.
So people shouldn't prepare for recession at the moment?
Yeah, no, I don't think from, again, what we observe right now, that's not a risk factor for us. Obviously, if those conditions change, and they could change in a short period of time, then that's the time to be concerned and adjust the strategy accordingly. But for now, what we observe, we don't see those conditions.
Political uncertainty, another issue, particularly these days, it seems.
Yeah.
There's a lot of it around. What can investors do to position for that? Or can they?
Yeah, actually, I mean, the best advice on this is actually to ignore it. It's a lot of noise. I mean, you think about the last 10 years, just to use that as a data window, if you like, and how much political uncertainty there has been in the last 10 years, whether it was some of the challenges that the European economies faced around the debt defaults and all of the changes in governments there, whether it's the referenda that we've had in the UK and elsewhere, presidential elections in the US, they caused a whole heap of political uncertainty, yet stock market returns and general investment returns have been quite compelling. And the best thing would have been to ignore the political uncertainty and to just focus on some of the other drivers, the fundamentals for those corporations and economies. Political uncertainty is here to stay. We live in a world where it's likely to persist, and actually being fearful of it is not necessarily the best thing to do right now, because that will only lead one to miss out on some very compelling opportunities.
Fair enough. And finally, a change of government in the UK is, well, not likely as such, but certainly a risk factor for the economy and the market. What do you think of that? Do you think that a Corbyn government would be something that you would change people's perceptions?
That. Yeah, I think that maybe the way to think about it, there's two aspects to that. One is the probability of that event happening, and there will be a series of things that would need to happen before that prevails, and not even just the probability of a Corbyn government, but the probability of some of at least the policies that have been discussed whilst Corbyn is in opposition get passed and actually take place. So there's a whole series of unknowns that nobody can predict. But even were they to prevail, what information can we derive on stock market returns? And we looked back over the last 100 years in terms of change of governments in the UK between Labour and the Tories, and even going back as far as the Liberals. And we actually observe that the stock market and the economy performs equally well under the Labour government as it does under the Conservatives. So very similar performance, lots of volatility and variations, but they weren't driven necessarily by who was in power, but other dynamics that were at play at the time, the global financial crisis, for example, and or the dot-com bubble or the oil price, rather than who is at number 10.